Good evening, students. Welcome to the session. I hope you have revised and come for today's class. We'll solve with the next problem. Before we revise the next topic under the PGBP itself, we'll solve one more question around PGBP. I have already shared that to you in the last class itself. Let me open up the question for you. Okay. So, PG Private Limited is engaged in multiple businesses. The net profit as per the statement of P&L was 52 lakh for the year ended 31st March 2024. The scrutiny of the statement of P&L revealed the following items which were debited or credited therein. Now, this is also concerning the partnership firm. So, share income at the rate 25% from a partnership firm ABC and Co of Pune, 9,50,000. Company paid rupees 1 lakh as service charges to a call center for attending the calls of customers and suppliers. The tax was deducted at source on such payment at the rate 2%. Expenditure incurred 8 lakh for digging of wells near the factory for use by public under the CSR scheme as per the Companies Act 2013. Grant received from the state government for acquisition of generator rupees 10 lakh. The generator was acquired on 1/6/2023 for 25 lakh. A sum of 5 lakh was paid as advance by cash to the supplier of generator. The grant amount received is credited to the statement of P&L. Depreciation charge is on 35 lakh at the rate of 15%. Assume that the company is not eligible for additional depreciation. During the year, the company bought textile goods from local supplier. Cash payment was made exceeding rupees 10,000 but below rupees 20,000 in a day to 15 suppliers, aggregating to rupees 2 lakh. Depreciation debited to the statement of P&L 10 lakh. It includes 8 lakhs being the depreciation on assets revalue. Provision for deferred tax debited to statement of P&L is 6 lakh 50. Trade creditors 5 lakh were outstanding for more than 5 years and there is no business relationship with them. The amount was unilaterally transferred to credit of statement of P&L. Royalty income in respect of patents chargeable under 115 BBF is 12 lakh. Depreciation eligible under 32 before considering the adjustment of any of the items described above is 12 lakh 25,000. There is this additional information given. The assessee executed one civil construction contract of value of 15 lakh. The contractee withheld 20% of the contract amount which would be released after 2 years. The amount Okay, thank you. Yes. So during the year, the company advanced 5,50,000 to one of the directors having 22% of equity shares and equivalent voting rights in the company. To meet his personal expenses, the company has accumulated profit of 25 lakh as on 31st March 2023. You are required to compute the total income for the AY 24-25, stating clearly the reasons for treatment for each of the items given below. So let's start the question. Let's start solving one by one. We'll answer it simultaneously. So this is a company which is engaged in multiple business. What is the net profit? My net profit is 52 lakh. Then it says share income at the rate 25% from partnership firm ABC and Co of Pune 9,50,000. Yes, what will happen in this case? What would be the treatment of 9,50,000? Good evening, Namrata. Yes. What will be the treatment of 9,50,000 students? Faster. This is very simple also. Yes, quickly tell me. So this is the income from the partnership firm, the profits which are derived. What will be the implication over here? Yes, fast. This is not at all difficult. Share income from partnership firm. Taxable or not? So share income from the partnership firm is exempt under section 10(2)(a, student. So profit share from the partnership firm is exempt. Now this is a particular company. This company is a partner in a partnership firm, this BG Private Limited. So the share of profit, what it derives from the partnership firm would be exempt. Now, since it is credited to the P&L account, what we would do in this situation? So, since it is credited to the P&L account, what we will do in this situation? Yes, faster. Should we allow it to be credited to the P&L account? Yes, reduce from profit, right, Viraj? So here what we need to do is, since this profit is exempt, we need to reduce it from the profit and loss account. So let's start solving this question. Start making the notes now. So my net profit was how much? 52 lakhs. Here, less share of profit from partnership firm, 9.5 lakh, as exempt under section 10(2)(a). Is this clear? Okay. Then the next point was the company paid 1 lakh as service charges to a call center for attending the calls of customers and suppliers. The tax was deducted at source on such payment at the rate 2%. What will happen in this situation? Yes. Service charges paid to a call center. Yes. This is a question from TDS perspective. So, how much should be the TDS, under which section first you will look into for the purpose of the call center payments? Which section do we need to look into, students, first? 194C, 194J, which one? Yes. What is this? Is this a contract payment? Is this a consultancy? What is it? Is it a technical service? What will you look into? Yes, yes, faster. Is 2% correct? Yes, I'm not getting any answers. You're not revising properly. Yes, faster. So for the call center payment, students, under 194J, there would be TDS. Under 194J, what does 194J says? 194J says that any fees for professional services, technical services, or any royalty or any remuneration to a director or a non-compete fee which is referred to in 28(5)(a). On that, there should be the requirement to deduct the TDS. On the FTS and on the royalty, what is the percentage of TDS? It is 2%. So 2% in case it is FTS, not professional services, only FTS, technical services. Or royalty, where the royalty is in the nature of consideration for the sale, distribution or exhibition of cinematographic films. It is 2%. On all other royalties and on professional services and on the non-compete fee, on the director's remuneration, it is 10%. If the sum paid exceeds 30,000 and 30,000 limit is available for each of this. 30,000 for professional services, 30,000 for technical, 30,000 for director remuneration, 30,000 for royalties, 30,000 for non-compete. For each of this, there is a separate limit of 37,000. However, it says that in case of the assessee who is engaged in the business of operation of call center, then in that case, only 2% TDS will be applicable. So here, if you look at the question, it says that the company paid 1 lakh as service charges to a call center for attending the calls of customers and suppliers. So now the payee, the recipient, is in the business of the call center. So here, these are service charges. These are fees for technical services. No doubt about that. So TDS under 194J will be applicable. And for call center business, it is specifically 2%. So here, there would not be any issue. So means the TDS has been appropriately deducted. Are we clear? Yes or no? Yes. So here, what will be the implication over here? Will there be any effect? Yes, will there be any effect here? Should we add, should we reduce this amount? The answer is no. We don't need to do anything in this particular case. Rahul, how to differentiate between a technical fee and professional fee? This is a very, very relevant question that we have asked. So Rahul, what they say is, under 194J itself, they say professional services means services which are rendered in the course of carrying out legal, medical, engineering, architectural, accountancy or technical consultancy or interior decoration or advertising or the professions which are notified under 44AA. So CA, CS, information technology, doctors, all of those notified professionals under 44AA. That is the professional services. Technical services would be something which is not professional in nature, which is not specifically falling under 44AA. That would be technical. But it is very sometimes difficult to distinguish between professional and technical. So on the safer side, practically what we do is we deduct 10% only. We never go for 2%. Unless you are into a call center business. Because there's a very thin line between the two. But what the Act says is whatever notified professions are there under 44AA, that is your professional service. Are we clear, students? So here, since I have deducted my TDS at 2%, I don't need to make any further adjustment over here. So no adjustment is required. There will not be any disallowance over here. Third point. Expenditure incurred of rupees 8 lakh for digging of wells near the factory for use by public under corporate social responsibility scheme under CSR scheme of the Companies Act 2013. What will you do in this situation? CSR expenditure incurred of 8 lakhs on construction of wells in the factory nearby. Viraj, not allowed as expense? That's correct answer. Which is the provision? Which is the provision? Last time we discussed about it. Yes, Rahul, you are correct. CSR expenses are disallowed. That's right. Which is the provision? Section 37, explanation 2. If you recollect there, in the allowances, disallowances, we had specifically dealt with this particular point under section 37. So there, I had told you that 37 explanation 2 says CSR expenditure is not deemed to be in the nature of expense for business or profession. So you will write like this over here. So add CSR expenses is allowed as per explanation section 37. Fine? Yes, Namrata, you are correct. Next is grant received from the state government for acquisition of the generator. The generator was acquired in June 2023 for rupees 35 lakh. Sum of 5 lakh was paid as cash, was paid as advance by cash to the supplier of generator. The grant amount received is credited to P&L. Depreciation is charged at the rate of 15% on 35 lakhs. So what will you do in this situation, students? Yes. First, we'll talk about the grant. What will be the implication of the grant? Yes, you're right, Viraj. So the grant which is received from the government will be reduced from the cost of the capital asset. It will be also reduced from the P&L because it has been included in P&L. Which ICDS? Which ICDS tells me this? We discussed in the last lecture. Rahul, I will try to take that question also, surely. Yes, Namrata, you are correct. But which ICDS tells me this? Yes. So, ICDS what? Which ICDS gives me the power to do this, to reduce this? ICDS 7, government grants. Remember, for a depreciable fixed asset, reduce from the actual cost. Also, your explanation to section 43(1) also tells me this thing. Also, the meaning of actual cost also says the same particular point. What is the meaning of actual cost as per 43(1)? It says actual cost to the assessee less any cost met directly or indirectly by any other authority. Also, explanation 10 to 43 also says subsidy or grant or reimbursement by the central government or state government has to be used from the actual cost. So therefore, what will you do in this situation? Here, we will reduce the grant received is not income as it relates to the depreciable asset. So, I will reduce it. How much is the amount? 10 lakhs. And I will also reduce it from the cost of the asset to calculate the depreciation. Isn't it? So, what is the amount that I have paid for acquiring the generator? 35. So, for the purpose of depreciation, this is my working note. So, actual cost 35 less grant reduced as per explanation 10 to section 43(1) read with ICDS 7. Fine. How much is the government grant over here? So my government grant is 10 lakh, right? So I will reduce that particular thing. Clear? So 10 lakh, I will reduce it. Fine. Then it says a sum of 5 lakh was paid as advance by cash to the supplier of the generator. What will be the impact for that? Yes. Yes, Namrita, you are correct. That is right. So more than 10,000, you will not allow as the part of the actual cost. Again, what is the provision for that? Section 43(1). So if you remember, I told you under 43(1) itself, assets purchased in cash greater than rupees 10,000 are not allowed, are to be reduced from the cost. So yes, Viraj, you are right. We have to reduce 5 lakh from the cost. So less asset.
प्रेरणा, ये तो 1-to-1 सेशन हो गया विराज का, चांदी हो गई. राजकुमार अडुकिया here.
Yes, sir. Good evening.
Good evening.
So there are other students also who have joined from the link also, not through the Zoom.
नहीं. There is only one student, Prerna.
No, on Zoom, students, sir, but there are other students also whose queries are visible on the query link, which is there on the portal.
Should not be. Madam Dimple.
Yes, sir. Good evening, sir.
We should give wide publicity. We spend so much amount, so much energy.
Yes, sir.
You are
Uh,
such a responsible officer. If the wider number of students don't get benefits, okay, thank you.
oh,
Okay. Students, so what would happen is here asset purchase, I will reduce rupees 5 lakh in cash. Fine. I will reduce this amount of 5 lakh in cash. Fine. Now, what is the next adjustment over here? Next one is, it says that the depreciation is charged at the rate of 15% on 35 lakhs. So what will happen in that particular situation, student? Yes, depreciation of 35 lakhs, which is charged or 15% on 35 lakh. So what would you do in that case? Depreciation will get reduced. No, Viraj, that will not get reduced. Why it will get reduced? Yes. Here we will add back the depreciation, isn't it? We will add back because the depreciation has been charged on 35 lakhs. Isn't it? Depreciation is already charged on 35 lakhs. Isn't it? So here what we will have to do is, we will have to first add back the depreciation because I'm not allowed the depreciation on 35 lakhs. Sorry. Yes, Viraj, correct. So depreciation on rupees 35 lakh for generator. So 15% on that, 5.25 lakh. Isn't it? Then you will allow the actual depreciation. You will allow the actual depreciation. So what is my actual depreciation over here? My actual depreciation over here should be on 20 lakhs. So depreciation on generator, the rate is correct, isn't it? The rate is correct. It is plant and machinery only. So on 20 lakh, this should be 3 lakh. So less depreciation on generator 3 lakh. You have to write refer working. Yes or no, students? Fine. Okay. Next one is, during the year, the company bought textile goods from local suppliers. Cash payment was made exceeding 10,000 but less than 20,000 in a day to 15 suppliers, aggregating to rupees 2 lakh. So what will happen in this case? Whether you will disallow this 2 lakh or not. Yes or no? Yes, students, faster. What will happen? Which is the provision over here? 48.3, isn't it? So we'll go back to that provision. So 48.3, what does it say? Yes, faster. Expense in cash greater than 10,000 would not be allowed. Expense in cash greater than 10,000 would not be allowed. Now here, what they are trying to say here in this adjustment is that the company has bought the textile goods from local supplier. The cash payment was made exceeding 10,000 but below 20,000 in a day to 15 suppliers. So what, to 15 suppliers I have paid more than 10,000 in cash. This will not be allowed to me. This is also not falling under any rule 6DD exception. So only if I have purchased the goods from cottage industry, manufactured by cottage industry, then that's a different story. However, here this is clearly not falling under any of the exception also, isn't it? So therefore, here what we will do is add back disallowance for cash payment suppliers. How much is the amount? Amount is 2 lakh, not 10 lakh, sorry. Okay. Next adjustment is depreciation debited to the statement of P&L 10 lakhs. It includes the 8 lakhs being depreciation on assets revalued. So what will be your implication? Depreciation debited to the statement of P&L 10 lakhs. Yes. What you will do? Add back the depreciation, isn't it? You will add back the depreciation. But now students, here we have already also considered the depreciation for the generator. So what will happen to that? So for generator, we have already considered the depreciation, isn't it? Yes. What you will do in that case? So we'll assume here that this particular amount of depreciation on generator, this 3 lakh which is there, we will make an assumption that this is included as a part of entire 10 lakh. Yes, you're right, Viraj. So in that particular situation, we will make an assumption that this is not over and above, this is something which is considered as part. So here, what we will do is we will interpret the statement to mean that the depreciation for generators has been included in the said figure. And accordingly, we'll work out the solution in this particular case. So here, depreciation on other assets, we will assume 10 minus 5.25. $4.75 lakh. Are we clear? Yes? Okay. Then, what is the next adjustment? It says It also includes the 8 lakh being depreciation on assets revalue. That's fine. Provision for deferred tax debited to the statement of P&L account. Provision for deferred tax, what we will do for that? Provision for deferred tax. Whether any provisions are allowed? Yes, Virat, that's right. We will add back the provision for deferred tax. So, provisions are not allowed unless covered under ICDS 9. So here we will add back the provision for deferred tax, which is 6.5 lakhs. Next point. Trade creditors rupees 5 lakh were outstanding for more than 5 years. And there is no business relationship with them. The amount was unilaterally transferred to the credit of statement of profit and loss. Yes. What about the trade creditors? No change. Why? Why no change here? It's an income. You're right, Viraj. So, in this particular case, what is the enabling provision over here? Section 41(1). So, if you remember, in the PGBP, we had dealt with section 41(1). What does 41(1) says? 41(1) says that in case there is any particular expense that has been claimed, any expense which has been claimed, so in that particular case, if that is now written off, so there is any deduction which has been claimed in respect of a loss, expenditure or a trading liability, and the benefit is obtained through the remission or cessation of such liability, then this would be deemed to be the income. This would be deemed to be my income under 41. So here in this question, what they are saying is, they are saying that the trade creditors were outstanding for more than 5 years and now this is unilaterally written off. Unilateral write-off will also lead to the consideration of this as income. Now these trade creditors, I would have claimed this as an expense of purchases. Right? What entry do I pass? Purchase account debit to creditors account, isn't it? So the purchases would have been claimed as a deduction. The expense of purchases would have been claimed as deduction. Now when this is, I'm writing it off, even unilateral write-off, this would be considered as income under section 41(1). And since this is already credited to my profit and loss account, I will not make any other adjustment. So you can just write it over here. No adjustment for trade creditors write-off as already considered as income under section 41(1). Are we clear? Next is royalty income in respect of patents chargeable under 115 BBF. Yes. What will be the implication of this? Yes, students. Royalty income in respect of patents chargeable under 115 BBF 12 lakh. Considered separately. Separately as in Viraj, whether it will be business income or not. Yes. Yes, whether it will be business income or whether this be other sources. So see, this is going to be business income. Since the question says it is engaged in multiple business, so we will not make any adjustment. No adjustment as a royalty is business income. This is more so relevant if the question wanted you to calculate the tax. So in that case, see, what would happen is students, in case the tax rate has to be computed, then it becomes all the more relevant because for 115 BPF, the taxation is on the gross basis. Gross basis meaning 10% on the gross receipts. No expenditure allowed. In that case, if there would have been questions saying that the expenditure is, let's say, rupees 50,000, you would have disallowed that expenditure and you would have considered this as an income, which is a separate income. We will do that kind of sum also for the tax rate calculation. So in that particular case, you will have to calculate the tax. Let's say, for example, if the question says you compute the tax, you will consider the tax rate of a company, whether you consider it as a 30%, whether you put it under 22%. The royalty 115 BBF income will be continued to be taxed under 115. Even if you claim the concessional rate of 22%. Even if the question says you calculate the MAT, even in that situation as well, students, you will have to consider the MAT. From MAT calculation, you will reduce this. This is an allowable adjustment even under MAT. So there would not be any problem as such. This would be continued to be taxed at the 10 rate of 10%. Are we clear? But here, since there is no mention that you have to calculate the total tax liability, there is no problem. Are we clear? Then it says next adjustment is depreciation eligible under section 32. Before considering the adjustment of any of the items described above, rupees 12,25,000. So here the question itself has given you the adjustment for the depreciation of 12,25,000. But before considering any other adjustment, so what will be the impact over here? Yes. So this depreciation under 32 is already given to you, which is 12,25,000. Yes. So it says that the depreciation eligible under 32 is 12,25,000. They have already given over here. What will be the impact over here? So depreciation is higher because of generator. We need to reduce it. You are right. So how much you will reduce it, Viraj? Yes. How much we will reduce it? On rupees 15 lakhs? Yes. So on rupees 15 lakh, we will reduce it from this particular amount of depreciation. That is your right. So what he has assumed here is that the computation has been made on the basis that the eligible depreciation which is there here under section 32, 12,25,000. Here this includes the depreciation on the generator which is of 15 lakhs which was to be reduced, which was not allowable in respect of payment made in cash and the grant given by the government. So on that basis, you will reduce that amount. Are we clear? So then in that particular case, less so this depreciation has been reduced to be added back. So here on generator. Depreciation on generator which is or what we can do is, see students, here what we can also do is this 12 lakh which is there. This amount of 12 lakh 25 which is there. From this, what we will do is we will reduce the amount of the depreciation which is we have already considered over here, which is 3 lakh. So this 3 lakh we are any which ways reducing it, right? This 3 lakh we are any which ways reducing it, isn't it? Because what is happening here is that 12.25 lakh is already reduced. So one's way is that you do not reduce this particular amount because 12.25 lakh includes it. So from 12.25 lakh, you just add back the 2.25 lakh. So on 15 lakh into 15%. Point 5 lakh. You just add back this. And no need to separately reduce this because any which ways you have considered this particular amount. Are we clear? Similarly, over here also, depreciation on other assets. If you see 4.75 lakh, we have reduced it and 5.25 lakhs we had considered separately. What we could have also done is we could have directly written 10 lakh also. That is also fine. Is this correct? So this amount is already reduced. So then we no need to make any adjustment. What we just need to do is we need to add back 2.25. Is this clear? So from the depreciation amount, the allowable depreciation is just 10. Fine. And that is already reduced. Next impact is during there is additional information. The assessee executed only one civil construction contract of the value of 15 lakh. The contractee withheld 20% of the contract amount, which would be released only after 2 years. The amount withheld has not been credited to the statement of P&L. So what will happen in that? This is the retention money. This is the retention money. So what will happen in this case? Yes, students. Anything which strikes to you, what is going to be applicable over here? Yes. ICDS 3. What is going to be applicable over here is ICDS 3. ICDS 3 requires you to recognize the contract revenue, including the retention money, on the percentage of completion method. ICDS 3 requires you to recognize the contract revenue, including the retention money, on the percentage of completion method. So students, here what they are saying is that the assessee has executed a civil construction contract. So whenever the construction contract comes into the question, directly ICDS 3 should be striking in your mind. And this is the contractee has withheld 20% of the contract amount. This is nothing but a retention money over here. So here the question mentions that the assessee has executed the contract of value of 15 lakh. So which means here the contract has been completed because it says that the amount of retention money would be released after 2 years. So since the contract has been fully completed and we do not have an information over here that how much is the percentage of completion which has happened. See, one way is to assume that the contract is not yet completed, in which case you do not have the information of the how much is the construction which has been completed. What is the percentage of completion? You do not mention it. Right? So you do not know how much is the percentage of completion. So in that particular case, what would you do is, if you do not have information, you have to recognize the entire amount itself. But if the question gives you, let's say for example, the project has been completed only up to the extent of 25%. Project has been completed only to the extent of 75%. Then 15 lakh into 20% to 75% only you will recognize to the revenue. Here we are assuming that the contract is already completed, so we will add it over here. So add retention money 15 lakh into 20%. You have to write assuming contract is already complete. Here you can just write a note. ICDS 3 recognizes the contract revenue recognized on percentage of completion method, including the retention money. However, in question, the percentage of completion of project is not given, and therefore it is assumed 100% project is complete. Okay, so we will recognize here 3 lakhs. Fine. Next is, it says during the year 1 lakh equity shares of rupees 10 each was issued for rupees 25 per share. The fair market value as per Rule 11 UA of the share was determined at rupees 17 per share. What will happen in this case? So this adjustment pertains to what? Yes. This is pertaining to the income from other sources. Which section I am talking about? Yes. So I'll take you to that section so that we revise it also simultaneously. Which section I am talking about, students? Yes, faster. Which section it is? 56? Yes. 27B. Angel tax. What it says? This is applicable to a closely held company who issues the shares at a premium. Here, the company has issued the equity share of rupees 10 at rupees 25 per share. So where the issue price is greater than face value, when the shares are issued at premium by a closely held company. Remember, students, we had done the distinction in the that day's class, yesterday's class, that there's a difference between a widely held company and a closely held company. Closely held company is a private limited company or an unlisted company which is not a subsidiary of a listed company. So in that particular case, 5627B says that the closely held company, when it receives a consideration on issue of shares at greater than the fair market value, issue price minus the FMV as per Rule 11 UA would be taxable in the hands of the issuing company under 5627B. Under 5627B. It is not applicable where shares are issued to the venture capital funds, government, banks, insurance company, FPI, pension funds, or to the recognized startups. So 5627B is not applicable to a startup recognized by a DPIIT. Remember, I told you here, if the, let's say for example, the question would have said that this company is a startup. If the question would have told you that this company is a startup, then in that particular case, and if that company is recognized by DPIIT and it satisfies the other conditions if they are given in the question, or if just the question says that this company is a recognized startup by DPIIT, then 5627B would not have been applicable. If the question would have told me that here this company is a startup, then in that particular case, I would have not considered 5627. Are we clear? So here, this is going to be considered as my income from other sources. So here, my PGBP is over. I will calculate my PGBP over here. And then income from other sources, 56 to 70. Which is going to be issue price minus the F. So what is the issue price over here? Issue price is 25, FMV is 17, and how many 1 lakh shares are issued? So 25 minus 70 into 1. Take that. You can write here, if this company was recognized startup as per DPIIT section 56 to 7B would not have been applicable. Last point, during the year, the company advanced 5,50,000 to one of the directors, having 22% of the equity shares and equivalent voting rights in the company to meet his personal expenses. The company has accumulated profit of 25 lakhs. So in this case, what would happen? Yes. Yes, what will be the answer in this case? Yes, please. Amount advanced by a company to its shareholder. What would be the implication over here? Deemed dividend. You are right, Viraj. This would be considered as a deemed dividend. So, will there be any impact over here? Will there be any adjustment made over here? Yes. Let's go back to our EPOS class again. We'll go back to income from other sources and come back to 222E. So what I have told you for dividend. Dividend is taxable under 222E. Right? Dividend is taxable under 222E. So 222. Under 222E, this is again applicable only to a closely held company. This is only applicable to a closely held company, students. This is not applicable to a widely held company. So that's why there is a it's important to recognize the difference between different type of company. So any advances or loan to a shareholder who has greater than equal to 10% of voting power, or any payment on behalf of or for the benefit of shareholder who holds more than 10% of voting power, or any advances or loan to a concern, for example to HUF, AOP, BOI, or to any other company, or even to a partnership firm, in which this shareholder who is holding more than 10% of voting power has a substantial interest. Substantial interest meaning what? Is entitled to greater than equal to 20% of income of that concern. So to the extent of the accumulated profits, this would be considered as the deemed dividend. This would be considered as deemed dividend under 222. The only exceptions are loan granted in the ordinary course of business, loan where the lending is substantial part of the business of the assessee, or in the case of trade advances. But in whose hands this deemed dividend is taxable? Is it taxable in the hands of the company which is giving these loans or advances? Here what the question tells me is, here the question is saying during the year the company has advanced to one of the director who is also holding more than 22% of the equity share. If the loan would have been just given to a director, there was not a problem. Here, since the director is also holding the equity, that is why it also becomes a shareholder holding greater than equal to 10% of voting power. And that is why I would come into the definition of deemed dividend to meet his personal expenses for whatever I did. I am giving loan to the director who is holding more than 10% of the voting power or 10% of the shares. So to the extent of the accumulated profits, student, this would be considered as deemed dividend. But whose deemed dividend? Whether this would be taxable in the hands of the company who is giving the loan? Yes, or will it be taxable in the hands of the shareholder? In whose hands this would be taxable, students? Yes. In whose hands this is going to be taxable, in the hands of the shareholder or in the hands of the company? This would be taxable in the hands of the shareholder. Because it's a dividend of the shareholder. It's deemed dividend. I would have directly given you dividend. I'm not giving you dividend. I'm giving you loan, which is deemed dividend. So this is the income of the shareholder and not of the company giving the loan. The company just has to ensure one thing. Yes, Namrata, you are right. The company has to just ensure one thing. The company has to ensure over here that the TDS is deducted. The company is required to deduct the TDS at source. Otherwise, the company will have to pay the interest. Even if the company does not deduct the TDS, what will be the implication? Will there be any disallowance of expenditure? Let's say I am issuing a dividend to a company. I am issuing a dividend to shareholder without deducting the TDS. I would be treated as assessee in default. That is fine. I will be charged interest on late payment. Late filing of interest, there will be fee. Late filing of return, there will be fee. But will there be any disallowance of expenditure? Will there be any disallowance of expenditure? If I do not deduct the TDS on the dividend or on the deemed dividend, will there be any disallowance of expenditure? Yes, students. Will there be any disallowance of expenditure? Yes or no? There will not be any disallowance of expenditure. Dividend is not a deductible expenditure, isn't it? Dividend is distribution out of profits to the owners, to the shareholders. It is not a deductible expenditure. Yes, Namrata, you are right. So even if I do not deduct the TDS on dividend, at best, there will be interest on the late payment. But there will not be any disallowance of expenditure under 40A1A. Fine. So you have to write these points in your exam. So just write it over here. Dividend, or you can just write like this. Loan to the shareholder holding greater than equal to 10% of voting power is considered as deemed dividend and is taxable in the hands of the shareholder. The company has to deduct TDS under section 194. The company has to deduct the TDS under which section? Under 190, which is the TDS on the dividends. Isn't it? The company has to deduct the TDS under section 194 and has to deposit it with the government. Are we clear? Is this clear? However, non-deduction of TDS shall not result in disallowance as dividend is not deductible, as dividend is not a deductible expense. Okay, and what is the rate of TDS here? 10%. Are we clear over here, students? Is this question clear? Okay. Shall we proceed further? Fine. Now, we'll quickly recap again the sectorial deduction of PGBP before we go on to break, because then we will discuss the questions around that area. So let's first discuss the sector specific deduction, which is 33AB, 33ABA, which is deduction business engaged in tea, coffee, rubber development or site restoration fund. For especially tea, coffee, rubber development, you should be not only into the business of plantation of tea, but manufacturing of tea. Because if you are just doing the plantation of tea, that is considered as the agricultural income and that is exempt. So if you are only engaged in manufacturing plus plantation, then only there will be income which will be taxable and then you get the deduction under 33AB. So what is the eligible business? Growing and manufacturing of tea, coffee, rubber. What is the quantum of deduction under 33AB? Quantum of deduction is lower of amount deposited in the specified account with the NABARD or 40% of PGBP, whichever is lower. So the amount has to be deposited within the 6 months from the end of previous year or before the due date of filing return of income under 139 whichever is earned. So here you will have your PGBP income, you will get deduction under 33AB, which is either the amount deposited in specified account or the 40% of PGBP, whichever is low. Whatever total income you will get from that, the particular percentage would be taxable as per Rule 8, the other would be exempt because this is a mix of the agricultural income and the other. So you're not only into the growing of tea, coffee, rubber, but you are also into the manufacturing. So it's a mixed income. It's not purely agricultural income. Had it been a purely agricultural income, only if you are growing tea, coffee, rubber, then it's a purely agricultural. But since it's a mixed income, there will be some percentage exempt, some percentage taxable. Rule 8 says for tea, 40% taxable, 60% exempt. Rubber, 35% taxable, 65% exempt. Coffee grown and cured, 25% taxable, 75% exempt. Coffee grown, grounded and cured, 40% taxable, 60%. There are certain conditions which are given over here. Withdrawal of the amount from the special account. Amount cannot be withdrawn from the special account except as specified in the scheme. Amount can only be withdrawn for the following circumstances, which is either it is the closure of the business, partition of the HUF, liquidation, dissolution, or death. Even in that case, in the case of closure of business or in the case of dissolution, it is deemed to be the income of the previous year of closure or dissolution. So amount can be withdrawn only in the case when you are closing or on the death of the assets. Amount, if it is withdrawn for ineligible assets, that will be deemed to be PGBP. What are ineligible assets? Plant and machinery installed in the office premises or residential accommodation. Office appliances other than computers. Plant and machinery whose deduction has already been allowed in some other section. Plant and machinery used for manufacturing or production. These are all ineligible assets. Or if the amount is withdrawn but remains unutilized, again it will be deemed to be the income of the previous year of withdrawal. Any amount which is withdrawn, which is utilized for paying the business expense, then again you will not claim the deduction of expense because you have already claimed deduction under 33AB when you deposited the amount. Again, when you have withdrawn the amount for, let's say, paying out the salaries, you will not get any deduction of the expense. If the asset which is acquired in accordance with the scheme is sold or transferred before the expiry of 8 years from the year in which it was acquired, then if you have claimed the cost as the deduction, this cost allowed as deduction will now be deemed to be PGBP in the year of transfer. Because cost was allowed to you as deduction, isn't it? Now, you will be considering this as the deemed income in the year of transfer. The exception is if it's a transfer to government or it's a succession of firm by the company. Similar case is in the 33ABA, which is the site restoration fund. There, your business should be prospecting, extraction or business of the production of natural gas. In that case, the deduction under 33ABA is the lower of amount deposited to the specified account before the end of previous year or 20% of the PGBP. All the other conditions remain same. Next is scientific research expenditure. If you do the scientific research expenditure for your own business, you get the deduction of not only the current year expense, it can be revenue expense, it can be the capital expense. 100% of the expense is allowed. But capital expenditure should be other than land. So this is not only the current year expense, but even pre-commencement expenditure of prior 3 years is also allowed as deduction, both revenue and capital. Capital, again, except for the purchase of land, revenue should be salary and purchase of raw material. 100% of this is allowed in the year in which the business is commenced. This is available not only for the normal tax rate, but even when you adopt the concessional tax rate, either under 115 BAC, BAD, BAA, BAB, any of the concessional tax rates you claim, this expenditure would be allowed. Current as well as the prior year expense, capex plus revenue, both except for the cost of land. But if you pay to others, for example, pay to Indian company for scientific research, or you pay to the university, college or institution for statistical research, or you pay to any college or institution for scientific research, or you pay to a national laboratory or IIT, then also you will get 100% of the expenditure as a deduction under section 35. But when you claim the concessional tax rate under 115 BAC, BAB, BAB, all of those, that expenditure will not be allowed. So this side what I have written, this is not allowed when you claim the concessional tax regime. This side, which you do it for your own business, that is allowed. And any unabsorbed capital expenditure you have to treat like the unabsorbed depreciation. However, asset which is used for the scientific research, if you use it for other business then what will be the actual cost? Actual cost will be nil, because in the other business you will claim depreciation. So actual cost will be nil because you have already been allowed deduction under 30. But if you sell this asset, then this will be considered as the deemed income. If the asset which is used for scientific research is sold, then that will be considered as deemed income, which will be taxable under 41(3), which will be lower of the sale consideration or the deduction claim. Are we clear? If you transfer it to other business, then actual cost will be nil. Clear? Then you have 35 AD, which is investment based deduction. Again, here the 100% of capital expenditure, which is wholly and exclusively for the specified businesses, will be allowed as deduction. So 100% of the capital expenditure. So see, capital expenditure is not allowed as deduction unless specified. Here you will get 100% of capital expense, except for the land, goodwill or financial instrument. Cash expense more than 10,000 is not allowed. Here you will even get the prior period expenses, the prior to the commencement of business. If you have any capital expenditure, if you have capitalized as on the date of commencement of business, you will be allowed those expenses in the year in which the business is commenced. What are the conditions over here? The business should not be formed by splitting up or reconstruction of the existing business, should not be set up using old plant and machinery. Again, the same exception over here is that if the value of the plant and machinery, second-hand plant and machinery is less than 20% of the value of total plant and machinery, or if you have imported second-hand plant and machinery, this condition would be satisfied. Further, losses from specified business can be only set off against the profit from specified business. But you have to claim the losses before the due date of filing the return of income under 139. You can carry forward the losses indefinitely. Now, if you purchase the asset for which specified deduction is claimed under 35AD and you sell it off or you transfer within 8 years from the year in which the asset is purchased. So, if the asset is sold, demolished or discarded before 8 years, then the amount received is considered to be income under 28(7). If the asset is used for any other business other than specified business, then 2 steps. First, there will be deemed income. What will be my deemed income? Deduction already claimed under 35AD minus the notional depreciation which will be eligible on that asset. And actual cost for that asset, actual cost of that asset when you use it for other business will be actual cost of asset minus the notional depreciation. Unlike under section 35, where the actual cost is nil, here it will be considered as the deemed income plus your actual cost will be your actual cost minus notional depreciation. Are we clear? Then deduction for telecom and spectrum license under 35 ABA and ABB. Expenditure incurred for obtaining rights to use spectrum is allowed as deduction under 35 ABA. And expenditure incurred for license to operate telecom services is under 35 ABB. What is the expenditure? Capital expenditure incurred for acquiring the license to use the spectrum or right to operate the telecom services. There's a Supreme Court ruling in Bharti Hexa which had held that any variable license fee paid in installments is also a capital expenditure. Since this was towards acquiring the telecom license, even if it was variable based on the percentage of revenue, this is still towards obtaining the license, and this is be considered as capital expenditure. Here also you will get pre-commencement plus post-commencement, and here the deduction is allowed on the payment basis. So if the license fee is paid prior to the commencement of the business, you will be allowed the deduction in the year in which the business is commenced and till the year the license expires. And if you pay after the commencement of business, then from the year in which you pay the license fee till the license expires, you will get the deduction on the pro rata basis. If the license is transferred, and if my sale proceeds are greater than unamortized amount, then it will be deemed to be the profits in the year of the transfer. What is the deemed income? Sale consideration minus the unamortized amount or expenditure allowed till date, whatever is lower. However, if the sale proceeds are less than the unamortized amount, then in that particular case, if whole license is transferred, then unamortized expense minus the sale consideration is allowed as deduction. If it is part license is transferred, then it is allowed over the balance fee. Are we clear? Similarly, expenditure on VRS is allowed. So if you give the voluntary retirement scheme to your employees, then it is allowed 1/5 of expenditure over 5 years. Expenditure on amalgamation and demergers are allowed 1/5 over the period of 5 years. Then we had seen 43 CB and ICDS3. We have already seen that, right? So these are all these sector specific deductions which are available. Is it clear? Any questions so far? Any doubt? Any question? Yes or no? Yes. So we'll start solving the question around it. Also, one more particular expenditure or deduction, 35D. Indian companies and resident non-corporate taxpayers paying for preliminary expenditure for establishment of business or expansion of existing business before the commencement of business. Deduction is 1/5 of expense over the period of 5 years, beginning with the previous year in which the business commences or extension is completed or production commences. Limit is 5% of the cost of project or 5% of the capital employed, whichever is higher. What is capital employed? Issued share capital plus debt plus long-term borrowings on the last day of the previous year in which business commences. Are we clear? The share premium is not capital employed as held by Supreme Court in merger. For a non-corporate, it is 5% of cost of project, not 5% of capital. Are we clear? So this is what you have to remember, even one more deduction. So if this is clear, we'll take a break in case there are no questions. Then we'll start solving the questions around this area. So let's take a break of 10 minutes. Yes. Question then. Let me share you the question. Give me a minute. I've shared this question also. Okay. So Label Tea Limited engaged in the growing and manufacturing of tea. Net profit for the financial year 23-24 is rupees 50 lakh. Company was incorporated on 1st June 2021. Following were debited and credited to P&L. Depreciation is rupees 5 lakh. Charges of 1 lakh 30 paid by an account paid check for an advertisement in souvenir published by a political party. The company incurred preliminary expense of 42 lakh. Profit from sale of green tea leaves 20 lakh. Replacement of parts of plant and machinery amounting to 15 lakh, for which sum of rupees 30 lakh was withdrawn from deposit account maintained with NABARD. Rupees 10 lakh has remained unutilized. Depreciation claimed on computer is rupees 80,000 as per the Income Tax Act. Other information is given. The cost of project was 400 lakhs, share premium is 100 lakhs, capital employed is 700 lakhs. Company has acquired the plant and machinery at rupees 40 lakh, building at rupees 25 lakh and furniture at rupees 10 lakh. The company obtained bank loan of up to 50% cost of plant and machinery, which was then waived off by bank. Furniture of rupees 5 lakh was purchased in cash. Amount deposited in NABARD on 1/7/24 is rupees 6 lakh. Brought forward business loss is rupees 1 lakh. So let's start solving. Okay. So first is the net profit is 50 lakh and the company is incorporated on 1 June 21. They are saying depreciation is rupees 5 lakh. What will be the impact of depreciation? Yes. What will be the impact of depreciation? Book depreciation, yes, Viraj, we have to add it back. So this is not allowed to us as the deduction, isn't it? So let's just start solving the question. So net profit as per P&L is 50 lakh. Add back depreciation, which is 5 lakhs. Okay. Next one is charges of 1 lakh 30 paid by an account paid check for advertisement in souvenir published by a political party. Yesterday also we did the same adjustment around this. Yes, what will be the implication? Add back to P&L. Yes, you're right, Viraj. What will be the second impact? Take deduction. Under which section we'll get a deduction, Viraj? Yes. ATGGB it is, Viraj. You have to remember some sections. So here what we will do is we will add back what is the amount here? 1 lakh 30. Amount for advertisement in souvenir published by political party. 1.3 lakh. Chapter 6A deduction. Section 80 GGC. 1.3 lakh. What if the amount would have been paid in cash? What if the amount would have been paid in cash? Sorry, 80GGB, not C. 1.3 lakh. And this is disallowed under section 37 2B. Yes, if the amount would have been paid in cash, then disallowance would have been there. That's right, Virat. Cash payment is disallowed. That's fine. But what about deduction under section 80GGB? What would have been the deduction under 80GGB? Whether you would have got any deduction? No deduction. That's right. So cash deduction is not allowed even under 80GGB. If they would have said that the amount is paid in cash, then we would have not allowed a deduction even under 80GGB. Next is the company incurred the preliminary expense of 42 lakhs. What will happen to that? Preliminary expense just now we discussed. Yes. How much will be the deduction here? Allowed is 1/5. That's right, 1/5 of the expenditure. But how you will calculate it? How we will calculate it, we just now discussed. Under 35D, how will you allow it? Yes. Yes, faster we just now discussed, isn't it? So 5% of the cost of project. This is the limit. 1/5 of expenditure. But what is the limit? 5% of the cost of project or 5% of capital employed, whichever is higher. So here in the additional information, this is given to you that the cost of project is 400 lakh. What is the cost of project? It is all the fixed asset cost, including the land and building. So here it is already given in the question that the cost of project was 400 lakh. Capital employed is what? Your issued share capital plus debentures plus long-term borrowings on the last day of the previous year in which business commences. Here it is given the capital employed is 700 lakhs. It is also given that there is a share premium. And what I said, share premium is not part of the capital employed. Share premium is not part of my capital employee. So here, cost of project, which is there. How much it is? 400 lakhs. 5% of that you will calculate. 5% of capital employed also you will calculate. What will be my capital employed? Will I consider over here share premium? Will I add the share premium to capital employed? Yes. Will I add the share premium to capital employed? How will you calculate? What is the limit? So, my preliminary expense you are right. I will get 35 lakh, 1/5 of that. Sorry, 42 lakh, 1/5 of that. I will get this particular amount. But what is my limit? Limit is 5% of the cost of project or 5% of the capital employed, whichever is higher, not lower. So, higher of 5% of cost of project or 5% of the capital employed. As per Berger Payne's Supreme Court ruling, share premium is not part of capital. So what is the cost of project? 400 lakhs. 5% of that, 20 lakhs. What is my capital employed? 5% of 700 lakh, 35 lakh. So higher is 35 lakh. Higher is 35 lakh, isn't it? So this is the limit that I have, isn't it? This is the limit that I have, which is 5% of cost of project or the capital employed, whichever is higher. Now, what will be your 35D deduction? Yes. Yes, students, faster. Give me the answer. Yes. So 1/5 of the expenditure is allowed to me, isn't it? 1/5 of the expenditure is allowed to me. So how much is the 1/5 of expenditure over here, students? 1/5 of 42 lakhs. 8 point. This is within the limit. So this will be the allowable expenditure. So I will add back the preliminary expense claimed. How much is claimed in the P&L account? They have said 42 lakh. So 42 minus 8 point. This will be allowed to me over the period of 5 years. So 33.6 lakh is I will add. Are we clear, students? Yes or no? Okay. Fine. Yes, Namrata, you are right. Namrata, how 35 over 5 years? Yes. How much you will get over here? Whether you will get 35? Yes or no? So is this clear? You will get 42, isn't it? Because your expenditure which is there is how much? 42 lakh you have incurred. Now in this 42 lakh that you have incurred, what is the highest limit up to which you can claim the expenditure? So what they say is that for the 35D preliminary expense, what is my limit? It is higher of the cost of project, or sorry, 5% of the cost of project or 5% of the capital loan. So expenditure which is incurred. Now this expenditure can be any expenditure in connection with preparation of project reports, feasibility report, engineering services, all of those, all printing of memorandum, article of association, drafting of memorandum, legal charges paid, registration of company expenditure, all of those expenditure which is there. So what is the expenditure that will be allowed? 1/5 of the expenditure is, they say that the preliminary expenditure incurred shall be amortized over the 1/5 of the expenditure over the period of 5 years. However, the overall limit is 5% of the cost of project or 5% of the capital employed, whichever is higher. So 1/5 of the qualifying limit for each 5-year period. Over each year, you will get the deduction. isn't it? So yes, sorry, you're right. It's not 42, it is 35. This should be 35. Sorry, my mistake. So this will be 7 lakh. Okay. So here, you're right, Namrata. This is 7 lakh. So 42 minus 7, 35. Yes, is this clear? Let's move to the next adjustment. The next adjustment is profit from sale of green tea leaves, 20 lakhs. What will happen to this? Profit from sale of green tea leaves. Yes. Sectorial income, no, Viraj. Profit from sale of green tea leaves. What will be the impact over here? Yes, faster. 100% exempt. That's right. So you're right, Viraj. Here, 100% will be exempt. 100% will be exempt over here. So in this particular case, this is the agricultural income, isn't it? This is from the growing of the leaves and not from the manufacturing of the leaves, isn't it? So here it is growing and not growing plus manufacturing. So here you will have to claim the exemption under section 10, isn't it? So here you have to claim the exemption under section 10 because this is only from the growing of the leaves and not from growing and manufacturing. Yes, Namrata, you are clear. Right. Namrata, I'll explain once again the 35D as well. So first, here we will reduce the agricultural income. So, profit from exempt as agricultural income under section 21. So how much is the profit? It is 20 lakhs. Okay. Yes, Namrata. So Namrata, you were right that for the preliminary expenditure, we don't have to take 42 divided by 5, we take 35 divided by 5. It is 5% of the qualifying amount. What is the qualifying amount? 5% of the cost of product or 5% of the capital employed, whichever is higher. Here, capital employed will not add with the share premium because share premium is not capital employed as per Supreme Court judgment in Berger. So the higher amount is 35 lakh, 5% of capital employed. Of that, you will take 1/5, which is 7 lakh. And the balance amount, you will add it back what you have. So it's not 42 lakh ka 5%, it's 35 lakh. Of that, you have to take the 1/5. You have to take 1/5 of the qualifying amount and not of 42 lakh. Is this clear, Namrata, now? Okay. Next adjustment is replacement of parts of plant and machinery amounting to rupees 15 lakh, for which sum of rupees 30 lakh was withdrawn from the deposit account maintained with NABARD. 10 lakh has remained unutilized. First, we'll talk about 15 lakh. What will happen to that 15 lakh? replacement of the parts of plant and machinery amounting to rupees 15 lakh. Yes. Utilization is allowed as expense? No, it is not correct. So as I told you, any amount that you withdraw other than for the specified purposes, it is not allowed as the deduction. As when you have deposited the amount, you have already claimed the deduction under 33AB, isn't it? So you have already claimed the deduction in the year in which you have deposited the amount in NABARD. Now, when you withdraw and again incur some expenditure for same, you will not get the deduction. So expenditure from the amount withdrawn will not be allowed as the deduction. Are we clear? Yes or no? Okay. So therefore, we will add back the amount. Replacement of plant and machinery not allowed as deduction as expenditure from amount withdrawn is not allowed as deduction. So 15 lakhs I will add back. Okay, then it says 10 lakh has remained unutilized. What about 10 lakhs? Ten lakh has remained unutilized. Add back? Yes, you're right, Viraj. So we need to add back that 10 lakhs which is remaining unutilized as the deemed income. So you will have to add back unutilized amount. This is my deemed income. So 10. Now what if the question would have told you that I have withdrawn the amount and let's say used it for the purchase of office equipment. I have withdrawn the amount and used it for the purchase of office equipment, let's say 3 lakh. Let's say 3 lakh is used for the purchase of office equipment. Then in that case, what would you do? Not allowed. So if I have withdrawn the amount for the purchase of office equipment, that will also be disallowed to me if I have claimed it as an expenditure. Okay, so you can just write over here, if amount withdrawn for purchase of office equipment, this is not allowed. This will be my deemed, isn't it? However, let's say for example, if I withdraw the amount for purchase of computer, then yes, Namrata, you're right. Then in that case, yes, if I withdraw it for computer, If I withdraw the amount for computer is allowed. So that will not be considered as dealing. So this is not my dealing. Okay. Okay. Let's move to the next adjustment. It says depreciation claimed on computer is 80,000 as per the Income Tax Act. That is fine. If the depreciation is claimed as per the Income Tax Act, we will not make any adjustment in relation to that, because that is the depreciation which is allowed to. Okay. So if there is computer equipment, there is computer purchase. On that, if I claim the depreciation, and therefore there will not be any problem. Are we clear? Okay. Then the cost of the project is given under the other information. This is what we have already used. Then it says the company has acquired the plant and machinery of 40 lakh, building at 25 lakh, and furniture at 10 lakh. Now, first we look at the plant and machinery. The company has obtained a bank loan of 50% of the cost of plant and machinery, which was then waived off by the bank. So what will we do in this case? Yes. So plant and machinery, my cost is 40 lakh. Waiver is added as income? No. Viraj, we just now did it. What will be happening to waiver? We just now did. What is the meaning of the actual cost? Actual cost is the cost allowed to the assessee, the actual cost incurred by the assessee minus as had been met directly or indirectly by any other authority. So waiver of the bank loan which was taken for the purchase of plant and machinery has to be reduced from the cost. You're right. So waiver of the bank loan, this is as per the explanation 10, section 43(1). So 20 lakh we will reduce. So 20 lakh will be my plant and machinery. What will be my depreciation here at the rate of 15%? 3 lakh. Will there be any additional depreciation available? Will there be any additional depreciation available over here? Yes. Will there be any additional depreciation available? Faster. Additional depreciation is available. You are right. Yes. Yes, Namrata, correct. So here additional depreciation will also be available since this is in the manufacturing also. So additional depreciation at the rate of 20%. 4 lakhs. So 7 lakh is my depreciation. Now what about furniture? Furniture cost is 10 lakhs. They say that furniture of 5 lakh was purchased in cash. Furniture of 5 lakh was purchased in cash. So what will happen? Furniture of 5 lakh purchased in cash. Reduction. Yes. So you will reduce it from the cost. So cash purchase 5 lakh. What is the rate of depreciation on furniture? How much is the rate of depreciation? 10%. You are right. So it is 10% and not 20%, Amrita. So 50,000. So 7.5 lakh is what you will allow as the depreciation as per Income Tax Act. Okay? Fine. Now, what will be my PGBP? Yes. Now you have to calculate your profits over here. So what will be my PGBP over here? Okay, there is also a building of 25 lakh. On that also you need to calculate the depreciation. So depreciation on building, you forgot. So my building is how much? Building is 25 lakhs. How much is the depreciation on building? Depreciation on building is how much? 10%. Yes. Right? It's 10%. So it is 2.5 lakh. So it is going to be 10 lakh total depreciation and not 7.5 lakh. Is this fine? Okay, now what is my PGBP, students? Yes. So here, my PGBP will be 50 lakh plus 5 lakh plus 1.3 plus 35 plus 15 lakh plus 10 lakh minus 20 minus 10. Are you getting 86.3 lakh? Yes, Viraj, that's correct. So my PGBP is 86.3 lakh. Okay. Now what will be the deduction that I will get under 33AB? What is my deduction under 33AB? So it is lower of amount deposited in NABARD or 40% of PGBP before the brought forward losses. So I don't need to consider here the brought forward losses, students. What if there would have been an unabsorbed depreciation? Let's say if a question tells you that there is an unabsorbed depreciation, so what will you do? Will you reduce from 86.3 lakh or will you not reduce from 86.3 lakh? Yes. If there is unabsorbed depreciation, what will you do? Yes, students, fast. Faster. Will I reduce it from the PGBP? I will not reduce the brought forward losses. But what about the unabsorbed depreciation? Let's say if the question says there is 1 lakh of unabsorbed depreciation, then what would you do? Yes. Yes, you will reduce. So if the question says that it is also having unabsorbed depreciation, then you will reduce because unabsorbed depreciation is considered as the current year depreciation. Okay. So here, but the question is not saying that. So it is just before the brought forward losses, but you can just write down as it is current year depreciation. Okay. So 40% of PGBP is 86.3 lakh into 40%. So 34.52 or amount deposited in NABARD they have given in the question, which is 6 lakh. They have done it before the due date of filing return of income. Lower of that is obviously 6 lakh. So your deduction under 33 EB is 6 lakh. So 86.3 minus 6 lakh is 80.3 lakh. Now from this, you will have to divide it between the agricultural income and non-agricultural income. So what did I tell you? That 40% of this would be taxable and 60% will be agricultural income. So less 60% as the agricultural income. So this I will reduce it. So my balance income would be 32.12 lakh as the non-agricultural. From this, I will reduce the 80 GGB, which is 1.3 lakh, and that will give me 30.82 lakh as my total. Is this question clear? Yes or no, students? Yes, Namrata, it would be uploaded. I want you to go through this for 1 minute. Yes, so that it's very clear to you. UAD, Namrata, as I said, UAD is considered as the current year depreciation. So therefore, in that case, since it is considered as current year depreciation, so you'll consider the PGBP after considering UAD. Okay. How you are getting 30.88 lakhs, Viraj? It is 80.3 lakh. So 80.3 into 40%, 32.12 minus 1.3 lakh, 30.82 lakh. Yeah. Okay. Okay. Shall we move to the next question then? Okay. So let's move to the next question. Lotus Company Limited is a listed company located in Jaipur. It is engaged in the multiple activities at different locations. Books of accounts are maintained by each unit separately. The head office maintains books relating to common transactions. All the accounts are consolidated and the return of income is filed at Jaipur. Following information is furnished unit-wise for the year ended 31st March 2024. Medicine Manufacturing Unit Delhi, the company has reported net profit of 200 lakhs in the books of accounts of the said business unit. It entered into an agreement for the use of know-how owned by a renowned scientist It paid royalty of rupees 5 per unit of the medicine sold as royalty, and the amount of royalty paid during the previous year 2023-24 was 36 lakh. The company deducted the TDS on the amounts paid up to December 23 and omitted tax at source on the royalty of rupees 8 lakhs due for the period from January to March 24. The payee admitted the royalty income, fully paid tax, and filed his return of income before the due date specified in 139(1). The company paid 33,60,000, being 40% of basic salary and DA of the employees in notified pension scheme, and the amount so paid is debited as expenditure in the books of accounts. For the garment manufacturing, the net profit is given 90 lakh as per the books of accounts of the unit. It bought a trademark from Mr. Yellow for rupees 20 lakh, which is charged as expenditure in the books of account. Unit paid 3 lakhs as interest on loan from a non-resident Indian. The tax was deducted at source in March, but it was remitted on 6th May. Company paid rupees 6 lakhs, being the amount of income tax payable by employees on non-monetary perquisites provided by company. This amount is debited in the books of accounts as expenditure. For the fertilizer producing unit at Narmada, the company established a fertilizer producing unit in Narmada, which became operational in June 23. It had acquired a land of 1 CR and put up a building of 3 CR and installed new plant and machinery for 4 CR. Net profit as per the books is 220 lakh after deducting the depreciation on building of 30 lakhs and plant and machinery of 60 lakh. Warehousing facility for storage of edible oils at Chennai. It established a warehousing facility for storage of edible oils from 1st August 23. It made investments such as cost of land 2 crores, building 3 crores, plant and machinery 5 crore. Net profit without depreciation was 70 lakh. They have given some additional information. The company mobilized the capital during the previous year by public issue of shares. The application money was kept in bank pending allotment of shares. Interest income from the said deposit of 3.2 lakh is credited to general reserve. The company declared interim dividend at 10% of share capital, being 30 lakhs in October 2023. It has 27% shareholding in Wire Inc. Singapore, from whom it received 54 lakh as dividend in January 2023. Both dividends received and paid were credited and debited respectively in the consolidated statement of P&L. The total turnover of the company for the previous year 21-22 was 282 crore, and for financial year 22-23 was 405 crore. The company has the MAT credit of 20 lakhs of the assessment year to 11-12. The book profit is 620 lakhs. Compute the total income and the tax liability. Your answers must give the reasons. So let's start. First, it's a listed company. It is engaged in the multiple activities at different locations. The following information is furnished unit-wise for the year ended 31st March. Medicine manufacturing unit. Now the company has the net profit of 200. So first, how will you start this question? Yes. How will you start with this question? So first we'll start with the net profit of the manufacturing unit. Let's start with it. So net profit of medicine manufacturing unit. How much it is? It is 200 lakhs. Okay. Then it says it entered into an agreement for the use of know-how owned by a renowned scientist. It paid a royalty of 5 per unit of medicine sold as royalty, and the amount of royalty was 36 lakh. The company deducted the TDS up to December 23 and omitted to deduct the TDS at source on the royalty of 8 lakh for the period Jan to March. The payee has admitted the royalty income fully, paid tax, and filed the return of income before the due date under 139(1). So what will happen in that case? Yes. what will be happening in this particular case? Whether you disallow the royalty of 8 lakhs into 30% or what will you do? Yes, allowed, disallowed, what will happen? Faster? Faster, students, what will happen in this case? Whether we will allow the deduction or not, yes, it's not that complicated. What does 40A1 says? So, here 40A1A, it says that 30% of any sum payable to a resident on which tax is deductible and such tax has not been deducted or after deduction has not been paid on or before the due date of 139(1). Then 30% of the sum will be disallowed. However, the proviso says that where in respect of any sum, tax has been deducted in the subsequent year or has been deducted during the previous year but paid after the due date of 139(1), then 30% will be allowed to the year in which the tax has been paid. So meaning 30% will be disallowed if we do not pay the TDS before the return of income. The second proviso says that where the assessee fails to deduct the TDS, he will not be deemed to be the assessee in default if the assessee has deducted, if the payee has deducted, if the payee has paid the tax on the sum by the time he has furnished a return. So it says where the assessee has failed to deduct the tax, but it is not going to be disallowed for that assessee. It will be deemed that the assessee has deducted the tax properly and paid the tax on such sum on the date of furnishing the return of income by the payee. So if my payee has furnished the return, has taken into account this income and has paid the tax due, then it will be considered that the assessee has deducted on time and paid the tax on time. So in this case, there will not be any disallowance. There will not be any disallowance. So no disallowance in this particular case. As payee has paid the tax and included the amount before in the return before the due date, or can I file before the due date under section 139. Okay. Then the company paid 33,60,000 being 40% of basic salary plus DA of employees in notified pension scheme and the amount so paid is debited as expenditure to the P&L account. Now, what will happen in this case? Employer's contribution to the pension scheme under 80CCD. Yesterday also we discussed. Yes, this is 14% of basic plus DA. Yes. Yesterday also we discussed the same adjustment under 36(1)(4)(a). This is the deduction which is allowed. Yes. Students, faster. Yesterday also we discussed the same adjustment. Okay, let me tell you then. See, under 36(1)(5)(a), what 4A, what did we discuss yesterday in the allowances and disallowances? How much is allowed under 36(1)(4)(a)? So under 36(1)(4)(a), it is 10% of the salary of employee, salary plus DA, basic salary plus DA. Here it is 14% which is claimed in this question. So what we will do is, we will add back 10%. So contribution to the pension scheme allowed up to 10% of basic salary plus DD. See here, 4% will get disallowed. So what they have said is that 33,60,000 is the 14%. So 33,60,000 into 4 divided by 14 is what we will disallow. $9,60,000. So this we will disallow. Okay. Are we clear? This much is clear. So this is about the medicine manufacturing unit. Next, we go to the garment manufacturing unit. The company has a manufacturing unit at Tirupur, Tamil Nadu. It reports a net profit of 90 lakhs. So we'll take that. So this is first of all 209.6 lakh. Then we'll start with the second one, garment manufacturing. Net profit is 90 lakhs. Okay. It says it bought a trademark from Mr. Yellow for rupees 20 lakh, which is charged as expenditure in the books of accounts. So trademark of 20 lakh, will it be allowed? Yes, trademark of 20 lakh. What we will do in this case? Will you allow the deduction of trademark of 20 lakhs? Capitalization required. Yeah? So we will add back. We will disallow. So add trademark 20 lakh. But you will give the depreciation on the trademark. So you will allow the depreciation on trademark. What is the percentage of depreciation? What is the percentage of depreciation? Yes, Namrata, you are right. 25%. That's correct. So 25% you will allow as the depreciation. So which is coming to 5 lakh. Next is the unit paid rupees 3 lakh as the interest on loan taken from a non-resident Indian. The tax was deducted in March but remitted on 6th of May. So allowed, disallowed, what will happen? Yes. This expenditure will be allowed or not? Interest on loan. Allowed if paid before the due date of ITR. That's right, Viraj. So this will be allowed as it is paid before the due date of ITR. So interest on loan, no disallowance under section 40A1A as TDS paid before due date under section 139. Okay, last one is the company paid rupees 6 lakh being the amount of income tax payable by the employees on non-monetary perquisites provided by the company. This amount is debited in the books of accounts as the expenditure. So income tax paid on monetary, non-monetary perquisite. Yes. Faster. What will happen here? Allowed, disallowed. Interest on loan, as I said, Namrata, will be not disallowed under 40A1 because the amount of TDS has been paid before the due date of filing of return of income. It's 40A1, not 1A. It's non-resident. So if you pay the TDS before the due date of filing of return of income, then there will not be any disallowance under 40A1. Are we clear? Only when you not pay before the due date of 139.1, there will be disallowance. Yes. So 45, 40 subsection 5 provides that tax paid on non-monetary perquisites will be disallowed to you as an expenditure. Section 40, subsection 5. What does it say? It says that the expenditure which is paid, see, tax paid on perquisite on behalf of employees is not deductible. So we will add back the tax paid on perquisites under section 45. Are we clear? This 6 lakh we will add back. So here my total income will be 90 lakh plus 20 lakh minus 5 lakh plus 6 lakh. 111. Okay. Next one is fertilizer manufacturing unit. producing unit. The company established a fertilizer producing unit in Narmada, Gujarat, which became operational in June 23. It acquired a land for 1 CR and put up a building of 3 CR and installed the plant and machinery for 4 CR. The net profit is 220 lakh. So, chemical, or this is not chemical, fertilizer unit, right? Net profit is given as 220 lakhs. After deducting the depreciation, which is given. So what we'll do first with the depreciation? We will add back the depreciation of 30 lakhs and 60 lakhs. Okay. So add back the depreciation on plant and machinery and building. So 30 plus 60 lakh, this goes to 90. Right? This first we'll add back. Now what will you do in this case? What will you do in this case? What will happen? It's a very simple question. They have given that this company has acquired a land of 1 CR, building of 3 CR, and plant and machinery of 4 CR. So what will happen? Yes, this qualifies for 35 AB deduction. And that is why I've added back the depreciation, because when you claim the deduction under 35 AD, the entire cost of the asset is allowed to you. So again, you cannot claim the depreciation. Right? So therefore, we have added back the depreciation and we will allow here deduction under section 35. On land, there is no deduction. On land, there is no deduction. So, no deduction for land. As I said, land, goodwill, financial instruments will not qualify. So, what we will give a deduction of capital expenditure, which is pertaining to building and plant and machinery. So, for building, it is 3 crore. Plant and machinery, it is 4. So I will allow the deduction under 35 AD of the capital expenditure of 7 crores. So this will be 220 lakhs plus 90 lakhs minus 7 CR. So this will bring me to how much? This will give me 3 crore 90 lakh as my profit. So 390 lakhs. Isn't it? Yes, 3.90 crore. Fine. Last one. The last business is warehousing facility for storage of edible oils. Warehousing facility for storage of edible oils. The net profit without deducting depreciation is net profit, it is without depreciation is 70 lakhs. Okay. It says it has made the investments such as cost of land 2 crores, building 3 crores, and plant and machinery 5 crores. So here, this is the edible oil Warehousing facility for the storage of edible oils. So what will happen in this particular case? Yes. There is this information which is given to you for the building, plant and machinery and land. Will this also qualify for 35 AD? Yes. Will this also qualify for 35 AD? Yes, faster. Faster, students. Is this a 35 AD business? Fast. What are the businesses under 35 AD? Setting up and operating the warehousing facility for the agricultural produce. For the agricultural produce is a 35 AD business. Isn't it? So 35 AD is allowed on which all businesses? Cold chain facilities for specified product, warehousing for the agricultural products. So will this qualify fertilizer? Yes, certainly it qualifies. But will this qualify? Yes or no? Yes. Faster. This is not agricultural produce, right? This is not agricultural produce, isn't it? So here, profit from the business of setting up of the warehouse for storage of edible oil. Whether this will be available fast, I'm not getting any answer. It is available for setting up and operating a warehouse for storage of sugar and setting up and operating a warehouse facility for storage of agricultural produce. Whether this will qualify. Yes or no? Edible oil, whether it will qualify. It is not a specified business. This will not qualify. Yes, you're right, Viraj. So this is not an agricultural commodity. This will not qualify for 35. So not eligible for 35A. This is not eligible for 35A, students. Is this very, very clear? Yes, Namrata, you are right. Edible oil is not agricultural produce. Fine. So what we will do here, we will give the depreciation because this is net profit before depreciation. So we will allow the depreciation on building. So 3 crores into 10%. How much it will be? 30 lakhs. And depreciation on plant and machinery. It is 5 crore. Additional depreciation will not be available because this is not a manufacturing concern. Okay. So therefore, 5 crores into 15%, 75 lakhs. So here I am getting a loss. I am entering into a loss situation, isn't it? So here my loss will be 35 lakhs. Now, can I set off this loss? Can I set off this loss against my other income? Can I set off my loss with the other income? Yes, I can. Okay. So I will set it off and my total income would be 209.6 plus 111, 320 lakhs. Specified business will remain as separate, minus 35 lakh. 285.6 lakh is what I will get as my total net profit. Right? And if I include here for the time being specified business also, so 675.6 lakh. Fine? Okay. Now, other information is given. What is the other information given here? The company mobilized the capital during the previous year 23-24 by public issue of shares. The application money was kept in bank pending allotment of shares. The interest from the said deposit is credited to the general reserve. So what will be the effect of this? Yes. What will be the impact of this? We have done a judgment around this particular point. Yesterday also we discussed. Let's go back. Yes, what did we discuss yesterday? If you remember, this will not be considered as the income because this is received for the share application money which is kept. So interest on share application money is inextricably linked with the requirement of raising the share capital. So I have a statutory requirement to keep a share application money in a separate bank account. This amount which is there is not as a surplus fund which I have kept to earn interest. So this amount is kept in a separate bank account because there is a separate requirement and the interest which I am earning is incidental. So this will not be chargeable as income from other sources. This is a capital receipt and has to be reduced from the public issue expense. This cannot be credited to P&L account or taken as income from other sources. Henkel Spick judgment. Fine. So here we will give no impact to this. So interest on share application money, not income, capital C. Sorry. As this is incidental to the not as this is incidental income on share application money statutorily required be kept in bank. Okay. Last adjustment is Yes, Namrata, you are right. Last adjustment is the company declared the interim dividend of at 10% of share capital in 30 lakhs in October 2023. It has 27% shareholding in Wire Inc. Singapore, from whom it received 54 lakh as dividend. Both dividend received and paid were credited and debited respectively in the consolidated statement of P&L. So what will you do in this case? Yes. You can write here the name of judgment, Rama Multitech. Here also you can just write down. Instead of Henkel Speak, you can just write Rama Multitech, not Henkel Speak, sorry. Name of the judgment is Rama Multitech. Okay. Yes, what will you do for this particular case? This is Supreme Court judgment. In dividend which is earned and paid. Yes. Since the dividend is debited and credited to P&L, you will reduce it from the P&L less dividend paid. But one second, we have not taken the net profit figure as per the P&L. We have taken the net profit figure for the separate entity. So for the separate businesses. So any which ways we have not added the dividend. This is not included in the net profits which are given here because those are separate books of accounts maintained. So here you will add the dividend received under the head income from other sources from the foreign company, which is 54 lakh. Okay, which is 54 lakh. Now, this will give you the gross total income. This will give you the gross total income, and here you will get one particular deduction. What is the deduction which you will get? Under ATM, you will get a deduction. So where the gross total income of a domestic company includes any income by way of dividends, either from a domestic company or a foreign company or a business trust, then it is allowed a deduction of the amount equal to the amount by way of dividend received, as it does not exceed the amount distributed by it. So to the extent the amounts distributed by it, it will get the deduction. So here it has distributed how much? 30 lakhs. And it has received 54 lakhs. So to the extent of lower of these, less deduction under section 80M, dividend received or dividend distributed, whichever is less. So received is 53, right? Or 54, and distributed is 30 lakhs. So I will get a deduction of 30 lakhs. So my total income will be 675.6 lakh plus 54 minus 30. 699.6 lakh is my total. Then it says the total turnover of the company for previous year 21-22 was 282 and for 2023 it was 405 crore. So what is the impact of that? Since my turnover of previous year 21-22 was less than 400 crores, I will be eligible for a tax rate of 25%. Since turnover of previous year 21-22 was less than rupees 400 crores, tax rate of 25%. Isn't it? Plus, there will be surcharge applicable as my total income has exceeded already 1 CR. Isn't it? So here, what we will do is, we will calculate the tax here because the question asks us to calculate the tax liability. So 699.6 into 25%, 174.9 lakh. Add surcharge at the rate of 7%. Plus cess at the rate of 4%. So this makes it 194.62 lakhs. Okay. Then in the question, it also says that the book profit is 620 lakhs. The book profit is 620 lakhs. So they have also given a book profit. You don't need to make any calculation for book profit. They have already given you book profit. So on this book profit, there will be the MAT liability. You need to compare it. So MAT at the rate of 15%. So 620 into 15%. This comes to 90 lakh. This comes to 93 lakh. Right? Will there be any surcharge over here? Since the book profit is more than 1 CR, there will be surcharge which will be applicable, right? So, plus surcharge at the rate of 7% and cess at the rate of 4%. So, 93 plus 7% plus 4%. This gives me 103.49 lakh. Now, since the regular income tax is already more than MAT, there is no problem. If the regular income tax would have been less than MAT, then the tax liability would have been as per MAT, and I would have also got a MAT credit. I would have also got a MAT credit. Here, students also understand one more thing. Here, you also need to compare with the tax rate under 115BAE. 115BAE, where the tax rate is 25.168%. But in that situation, you will not get the deduction under 35AD. So you will not get the deduction under section 35AD in that particular situation. So the profit from the fertilizing product producing unit, you will take as is, because that was any which ways after depreciation. Because if you claim get 115BAA, you don't get the deduction for the 35. So we'll take 220 lakh as is profit because this was any which ways after depreciation. Okay, so if we take 25.168% on the entire income, which is, how much is my income? I will not even get ATM, right? I will not even get ATM, Will I get ATM? What are the only deductions allowed under 115 JAA? Sorry, 115 BAA. What are the only deductions allowed? 80 GGAA, 80 LA. Right? Only those are the deductions which are allowed under chapter 6A. You remember that? And 80M, whether it is allowed or not. So if we go back to our class for that we were discussing yesterday, the basic concepts. So if you look at it, for the company, if you go for 115 BAA rate, then you don't get chapter 6A deductions other than 80 GGAA, 80M and 80 LE. So you will continue to get the 80M also. Okay. So in that particular case, 80M will be available. So only thing is 35 AD will not be available. So what I'll do is I will take this 699.6 lakh and from this I will just take 222 lakh as the fertilizer unit profit. I will not make these adjustments because the net profit is any which ways after depreciation. If I am not claiming 35 AD, I will allow the depreciation. So 222 minus 90, I will just add back 7 crore, which I have reduced. So on this 531.6, I will allow 25.68% the tax rate. 133.79. 133.79, and whereas if I go as per the normal tax rate, I get the tax of 190. So in that case, it is beneficial to go as per the 115 BAA. It is beneficial to go as per 115 BAA. Are we clear? Any questions, any doubts so far, students? I want you to go through this question. Dividend point, as I said, Namrata, if you declare the dividend and if you receive the dividend, you get ATM deduction, which is lower of either the dividend received or the dividend declared. Clear? I want you to go through this question and let me know if you have any questions in the next class. Please go through it because this is a very, very important question. Is it clear? Okay. So I think we'll stop here for today. And in the next class, I want you to revise the capital gain because PGBP we have done 4 to 5 questions easily and thoroughly. We have done all the ICDS, we have computed all the deductions, disallowances, all of that we have done thoroughly. So in the next class, we'll begin with capital gains. So thank you so much. See you in the next class. Yes.